Okay, let's see. Like I said, I think this chapter is an easier chapter. So the first concept that they kind of cover in this chapter is a concept of decentralizing organizations. And what that means is the old conventional wisdom, and by old I mean even back to 70s and 80s, was that the best way to manage a company was in a centralized manner, meaning all the decision making happens by like one small, head guy or girl, whoever's running the company. Like that's, and there's been this shift in thinking to, and it happened before the 70s, but I'm saying up until the 80s and even the 90s, there was a lot of companies still run that way. But there's been this move toward what's called decentralizing, recognizing that a lot of times having each small individual unit of a business able to make many of its own decisions is a good thing, right? They can be more flexible, they can be more agile. The only downside is a lot of times then each of the units tends to compete with the other units, which competition can be good, but it can also end up meaning we each spend money on marketing that if we'd all gotten together, we could have done one marketing thing that would have benefited everyone or whatever. So there's pros and cons to it. We have that going on here at the college, where each academic division is kind of like its own little unit, headed by one of the faculty members. And they have their own budgets, and they make their own plans. But occasionally we'll make this plan that will be good for the business division, but that might actually kind of cut into the math division. And so we've got to coordinate this. Then we have to have this meeting every 2 weeks where all the department heads and the academic chairs all get together and say, we're thinking of doing this in the business division. How does that impact everybody else? And so, it creates another meeting. But by and large, it's been good because what we can do is see which divisions run the hardest and then say, what are they doing? And train everybody else and say, here's something they're doing in the business division, or here's something they're doing in the math division or communicative arts. Okay, so most of the time small companies are centralized by their nature, right? If you're a manager or an owner of a company with only 5 employees, well, guess what? All the decision making is going to be pretty centralized in that manager or that owner. But as they get bigger, you need to decentralize. You can't just have one person in charge of, even the college isn't giant, but we've got about 200 employees. We can't have one person trying to be the boss of all 200 of those people, right? Instead, like a division chair, I have 7 full-time people that I'm responsible for, 8 total, including me, plus like 20 part-timers. And I can barely manage that. I wouldn't want to have to manage 200 people, right? So we decentralize it to let the power and the decision-making come from lower levels. So some of the advantages I talked about just a minute ago, others I didn't. But these are the advantages of decentralizing control. Okay. Really what you need is your top managers focused on the big strategic issues. If they're focused on every little thing that every department is doing, they're never going to be able to really direct the company. I'll tell you, I found that as a division chair here at EAC, when I have the dean saying, so what's your strategic plan for the running of the business division? And I'm like, I'm barely keeping up with teaching my classes and writing people's performance reports and dealing with student scholarships and I don't have time to think strategic because I'm just dealing with operational stuff all the time. And so the lower we can sort of get decision making happening, the managers at this level are freed up to start being more strategic and start making plans and then ensuring those strategic plans are met. Okay. So you can read all those. I don't want to read them all to you, but those are the advantages of decentralizing. The disadvantages, like I said, duplication of cost. The fact that I want to do some marketing piece and so does communicative arts, but we both have separate budgets, and so we're all marketing various things instead of maybe working through the college to come up with a more unified voice and not spend so much on the marketing. And I love this term. This is such a management term, problems achieving goal congruence. What that means is, like I said before, we could start to sort of compete with one another instead of recognizing that we have similar goals. It's easy to sort of think of yourself as the business division instead of as Eastern Arizona College, and not think of communicative arts division as part of the same team trying to achieve the same goal, but instead to think of them as like a rival. And I have to outdo them, and my numbers need to be better than theirs, so it looks like I'm a good manager. Instead of saying, you know, what we're really trying to do here is give students the best possible education at the lowest cost. I mean, that's honestly what we want to do. And working together so that, you know, there's not a math class only being offered at the same time as one of our key classes. You know, we need to work together on that. So, believe it or not, accounting is part of this whole equation. And so what this is called is responsibility accounting. Each organization is broken up into various agencies or departments, and each of those is a responsibility center. They're responsible for some decision making. The question is, how do we create a system that A, measures how well they're doing, and B, encourages them to be working together with the other units in an appropriate way, right? Because at times, you want them to compete with each other. You want them to say, we can do better than that department, right? We can gather students in and we can make students feel cared about, and we can have students' completion rates be higher than the other guy. That's a good thing. It drives effort. But at other times, we want them working together. And so if we measure the right things, people tend to do what gets measured. Fortunately or unfortunately, when you know something's being measured, then you tend to do it. You just have to be careful what you're measuring and how you're measuring it when you're making the management decisions. Here at the college, they started measuring something called DFW rates. Anybody know what a DFW rate is? So they would look at me, they'd say, look at this class, and they'd say, okay, this class started with 25 students, 18 of them successfully completed. 7 of them either got D's or F's or W's. So 7 divided by 25, that'd be my DFW rate. So they started making this a part of our appraisals as instructors. How high was our DFW rate? They want it to be lower. They wanted students not getting D's or F's or withdrawing from courses. If you put on your microeconomist hat, if they start measuring DFW rate, what do you think is going to happen? So teachers are going to make an active effort to reduce DFW rate. And how can you reduce DFW rate? Well, you could teach them better, right? You could be a better teacher and fewer students would fail. Or, what's easier than that? Just make it easier for students. And that's probably not the outcome we wanted, but typically so remember, people do what is measured, and typically the easiest means of improving the measurement is what the default will be. Does that make sense? I'm not saying it's right or moral. I'm saying it's human nature. I've got to improve this number. So I found myself doing things like, especially my online classes. Somebody doesn't take an exam. 5 years ago, someone didn't take an exam. What do you think would happen? No, you didn't get an exam. 0. Now, send them an email. Hey, you missed the exam. I can extend that for a couple days if you need me to. A couple days later, please take the exam. There's no way you're going to pass this class if you don't take the exam. I'm begging them. So some students still don't. They fail the class. Others do after I beg them. Do you think I've prepared them to be successful at the university by doing that? Probably not. I mean, is your university professor with 250 students in the class going to chase you down and beg you to take the exam that you didn't care enough to take? Probably not. But me doing that has improved my DFW rates, right? The number of people getting D's, F's, or withdrawing has gone down because, you know, and I think students feel like I care about them when I do that. That's a positive thing. But there's trade-offs. So as much as this sounds like this is just more accounting, this is actually more of like where real life hits accounting, okay? In a business, if I'm a decision maker, how do I measure whether or not the decisions I'm making are having a positive impact on the organization? And how do I measure in such a way that encourages me to do the things that they need me to be doing? All right, so this is stuff that you'll see on homework assignments. We have 4 types of responsibility centers in a business. The first is called a cost center. The manager of a cost center is only responsible for controlling costs. So think of the college. Really, the only way we generate revenues is through students taking classes. Okay? We have a few other little things, but they're little. You know, we don't make enough on entry fees to the musical that's going to make a big dent in our budget one way or the other. So a cost center here at the college might be something like our computer services department. They keep all the computers running for the whole school. Okay? They don't bring in any revenue. They are just a cost to the college. Our maintenance department, they keep the grass beautiful. They don't generate any revenue. Indirectly, we could say the nice grass, students see it, they want to come to EAC because it's a beautiful campus, but that's pretty indirect, right? So really, they're a cost center. I can't hold their manager accountable for revenues. I can only hold that manager accountable for controlling their costs. That's a cost center. Second, a revenue center. In a revenue center, the manager is only responsible for generating revenues. I'll say this manager can't control the costs. This might be a sales department. Their only job is to generate revenue. So that's what we're going to measure them by. Anybody ever had a job where they try to measure your performance in some way and it feels unfair because they're measuring your performance based on something you don't have any control over? Anybody had that yet? You will, probably. It's frustrating. So the idea is if we identify the correct responsibility center, we're not tasking the manager with or measuring their performance on items which they don't have control over. Profit center, the manager is responsible for generating revenues and controlling costs. Okay? The college doesn't break down very neatly on that one. You know, what as a faculty member or as a business or as a academic division, do we are we you know we don't really do recruiting on our own. There's a centralized recruiting office. And then an investment center. The manager is responsible for the center's invested capital. So how efficiently are we using the assets we have? That's usually the higher levels, the corporate type levels, where they're making these decisions on, we have these assets, we're doing these business activities, how successfully are we using these assets to do that? Okay, so those are the 4 types of responsibility centers. There will be a question on the homework that's going to be like, you know, word-based, like where you'll have to match these things up. So I suggest using the book when you get to that one. There's a summary that's right in the book. It's all the things I just said. A little column about responsibility reports is actually pretty valuable. A cost center, the report that their manager is responsible for compares actual costs to budgeted costs. That's how we measure if they're doing their job. In a revenue center, we compare actual revenues to budgeted revenues. In a profit center, we compare actual revenues and costs to budgeted revenues and costs. In an investment center, we compare actual profits to budgeted profits, and we measure the return on investment and residual income of those areas, and we'll talk about those 2 measures, which we haven't done much with. I think we touched on them in Accounting 1, but didn't go very deep. All right. So like I said, what you have to do is develop this performance evaluation system. And as accountants, we usually deal with the financial side of the performance evaluation system, but we have to recognize there's more than just that, right? Like we could be really sound financially here, but if our students hate it and they're only coming here because it was close by or something, then that's not really valuable. So we may have, you know, a customer satisfaction aspect to this as well, or how happy are employees to be working here. We need to have a broader measurement. So here's the goals of a performance evaluation system. And we'll talk about and the limitations of them. This is good to know. So when we measure the financial performance of a business, those are almost always what we call lagging indicators. They measure how we did last quarter or last year. That's valuable, right? To say, well, what was my budget last year? How did I do compared to it? And then I can make adjustments moving forward. But it's also valuable to look at what's called leading indicators. And so we'll talk about some of those ideas that are like, you know, we found that like students' perspectives on what's happening at EAC and if it's a good place to be, that sort of is a leading indicator. It tells us something about our future. Like if we go out to high school students and say, in the local community and say, what's your overall impression of EAC? If it's positive, that tends to mean that our enrollment's going to be strong. And if it's weak, it's going to be weaker. For us, the economy is a leading indicator. If the economy nosedives, the local economy, say the price of copper, which drives our local economy a lot, if our economy tanks, we're going to have increased enrollment. Why? Because the mine's going to lay off. People aren't going to know what to do with their life. They're going to go back to school. Or young people getting out of high school can't just go work for the mine. Instead, they go, I guess I'll go to school. Last couple times it's happened too, it's not only been a leading indicator of enrollment trends, but also an indicator of student quality. Students who come to school because they didn't want to, but there wasn't a job there for them, so it was the only way to get their FAFSA money, they're not that excited about being at college. Some of them are. There's some of them that are like, I really love this, I'm glad I got to. But students who, when the job market's really flush and people could go to work, and they're deciding, even though I could go to work, I'm putting that off because I want to go to school because I think it's going to be better for my future. Those are usually stronger students. So you've got to discover for each business, each organization, what the leading indicators are, and that just happens through experience and time. All right. So the answer that we do now is called a balanced scorecard. It's a form of a performance evaluation system that considers not only financial aspects, but many other aspects. And again, each organization sort of has to develop its own balanced scorecard. And management uses what we call KPIs, or key performance indicators, to assess whether the company is achieving its goals. All right, that's really tiny. You won't be able to see it. It's in your book if you want to check it out. So this is an example of a balanced scorecard. You see it has 4 perspectives: financial, customer, internal business, and learning and growth. And then some strategy developed around each of those, and then common key KPIs. So for example, financial things might be like our net income, our sales growth, our cash flow. Customers, it could be customer satisfaction ratings, repeat customers, customers who refer people to us. Those things could be measures for us. One thing we like to measure here at EAC is multi-generational students. What I mean by that is, how many of you, let me ask you, how many of you had a parent that came to EAC? Okay. How many of you had a sibling that came here? How many of you think will have siblings that come here after you? Okay, those things mean something to us, right? Because education is sort of a referral-based business, so to speak. People have a good experience at a college, or found it affordable, or both. They're likely to send their kids there. We have people, anybody have a grandparent come here? Yeah, your parents didn't? That skipped a generation with you guys? How about a great-grandparent? Okay. Great-greats? We have students here who are like the 5th generation of EAC students, right? Then we have other people who are like, I'm a 1st-generation student. No one else in my family ever came to college. And we're interested on why they came here too, okay? So those are customer. Even though our students, again, the college isn't maybe an exact match for what other businesses face, but we want to know why students are coming here, or why they're not. Those things matter to us. Internal business, things like new products developed, defect rates, it depends on the nature of the business. Learning and growth might be like employee training, employee satisfaction, stuff like that, okay? Those are the things we're trying to measure. Again, the important thing with these reports is that they focus on controllability. It is frustrating as a manager when you are levied or penalized even, or your bonus is impacted by measures that you have no control over. So it really takes time and effort for management to come up with a balanced scorecard that truly managers are only being judged on things they can control. It's important, okay? All right. So that leads us to this concept of what's a controllable cost and not a controllable cost. So as a division chair here at EAC, I have control of the budget over the business division, which includes the business department, the AIS department, that's the Administrative Information Services, computers department, small business management, FCR, Family and Consumer Resources, Cosmetology. I don't know why that one falls under me. So they all have separate budgets, and I'm responsible for overseeing all of those budgets. And if I say, hey, Jill, you're the department head over computers, I need you to sort of give me budget input so I can submit this budget to higher management. There's certain things Jill can control as the department head and certain things she can't. She can control the amount of supplies they use. She can say we need to use less or more, but she can't control the payroll. Payroll here is set by a table. The only way I can lower payroll is to fire somebody, and I don't have authority to fire somebody, actually. The worst I could do is write I could go talk to the dean and say this person needs to be fired, and then we'd go together and talk to human resources and decide whether they could actually be fired or if we needed to write up a report that would begin to process it, right? So some things for me are controllable costs and some things are not. How much my building costs? I can't control that. EAC said this is the building you can use, business division. So we use that, I can't control even the fact that maybe it's more expensive to cool this old building than it is to cool the high-tech center. Those are the two buildings that I have responsibility over. I can't control that. So I can just build my budget over kind of like this is what it costs. But then the things like supplies and the things like software and stuff like that, we can control those. So that's an important distinction to make, again, as you're building these sorts of measures. So we use something called responsibility reports, and you're going to see that they look a heck of a lot like variable, like budget, the variable budgets we've already done. They look like those. In other words, what was budgeted, what's the actual, and what's the variance between the two, and is it favorable or unfavorable? So again, cost centers reports focus on costs or expenses. So we're going to use flexible budget variance. That's it. You can read the rest if you want, but this is what it looks like. You see there's no revenue lines on that. Here, this is called a performance report. It has salaries, wages, payroll benefits, equipment depreciation, supplies, other expenses. And then this is called a responsibility report for the manager. Manager can't control salaries, they're fixed. Can't control payroll benefits. Can't control depreciation. So this is where we get down to what can the manager actually control? Wages, supplies, other expenses. That's really all they can control. How do you control wages? Have people work less, right? Say the office secretary is sitting there for 3 hours a day, so instead of that person working 8 hours a day, let's cut their hours down to 5. What's the downside to that? The office secretary might need that money for their family, right? So you always have to kind of try to balance those things and, say, can I find additional work for this person to be doing? Or do we just really not need a full-time person? Revenue centers, remember those focus on revenues. They can't control the expenses in a revenue center. So their responsibility report is going to have pretty much like sales volume, and that's it. Most revenue centers can't even control the sales cost price, right? That's probably dictated from the company above saying this is what we're going to sell these for. So really, a revenue center can control volume. Are you selling enough product? That's it. Profit centers, they do both revenue and expenses. So their performance report is going to look something like revenue, variable expenses, contribution margin, traceable fixed expenses. Traceable means fixed expenses that can be traced to that department specifically. And then they call it a segment margin. Then their responsibility report would just limit it to the things that that the manager could actually control. In this case, it's sales revenue and variable expenses. Wouldn't it be nice if every manager was saying, what can I control and what's my plan for controlling it? But they don't. Most managers just sort of come to work each day and do their job and go home. Controlling is an important part of their job. What are our variable expenses? I came in here the other night, and every single one of our Our thermostats was turned down to 69. I walked in the building, it was cold, and nobody was here. In fact, it was Saturday. And I was like, what does it cost to keep every building in this college at 69 as opposed to at 76 over the weekend? Start thinking of what that costs over a year's time. Could you imagine if Walmart managers could reduce the temperature they keep those buildings by 2 degrees times every giant building Walmart owned? That's something that's controllable. And it's a variable sort of cost, probably like a semi-variable cost. So that's how we need to be thinking as managers. And then investment centers. So in order to, like I said, in order to think about investment centers, we do want to still think about the same things we did for a profit center, maximizing operating income. But we also want to talk about efficiently using the center's assets. So I'll give you an example of this. I own a storage business. My storage business has, the main assets it has are buildings. And so if I have a building full, I'm efficiently using that asset. If it's not full, I could be making some money on that space that's sitting there empty. And so I have to make decisions like, do I try to, if I have some empty, do I try to have all the empties in one building so that they're all lumped together, and then if I have a customer who needs multiple units, I'll be able to give him those or something like that. If somebody, if we don't have the unit size someone needs, do I rent them a bigger unit but at the same price? Like in my case, I only have 8 5x10 units, and I have 10 10x20 units, and the remaining 65 units are 10x10s. So if somebody only needs a 5x10 and I charge $30 a month for that, I don't have any 5x10s because there's only 8 of them and they're all full, would it be a good thing for me to rent them a 10x10 at the $30 price? And the answer for me is like, yeah, I'd rather have it filled at 75% of the price than sitting there empty, right? But if all my other customers in the 10x10 start finding out I'm selling it to this guy for $10 cheaper than what they're getting it, I could have a problem. So I've got to manage those things. I know that sounds silly and kind of trivial, but that's business. How efficiently am I using the asset? I paid a certain amount for the asset, sitting on my books at a certain amount. Am I generating the revenue I need to from it? All right, so the first measure is something simple called return on investment, which is your operating income. Remember, operating income is your net income before interest and taxes. Sometimes it's called EBIT, earnings before interest and taxes. That's the operating income. So it's revenue minus variable expense minus fixed expense except interest and taxes. Why do you think we use operating income? Because interest and taxes is pretty much uncontrollable by everybody except the highest managers who decide if we're going to take on debt. And even then it's indirectly controllable. So remember operating income. Divide that by our average total assets. How do you think we find our average total assets? This is the part where somebody answers the question. It's a team effort. Where do you find assets at? Nobody knows where you find assets. Inventory is an asset. Where would you find information about that asset and other assets? On the balance sheet. The balance sheet has assets, liabilities, and equity. So your total assets will be listed right on your balance sheet. It's one of the big 3 items on a balance sheet. Total assets. How do you find the average total assets? Kind of, yes. Like add them up at the total assets at the beginning of the period to the total assets at the end of the period, divide by 2, and that'll give you the average across the period. Okay? So yeah, you add them up and divide by the number there is. That's correct. That's how you always find an average, right? So that's our average total assets. Porter, you didn't know that a balance sheet is where you'd find information on assets. I think you're just sandbagging on me. You're just sitting there quiet. You guys afraid I'll mock you or something if you're wrong? Is that why people are afraid to guess? All right, I got to work on that. Profit margin ratio is our operating income. Again, that's earnings before interest and taxes divided by net sales. Or in other words, how much of my sales revenue am I converting into operating income as a percentage? And then asset turnover ratio, my net sales divided by my average total assets. So the other one was like our operating income divided by our total assets. This is our sales. So one is, how are we converting or using our assets to generate profit? The other is, how are we using our assets to generate revenue? Okay, these are measures of efficiency. The last one is something called residual income, pretty commonly used. Again, RI achieves goal congruence better than ROI. Thank you, Professor. What the freak does that mean? So it's a measure of profitability and efficiency combined, okay? So we take our operating income minus, this says minimum acceptable operating income. That's another way of saying minus our target profit, okay? And the way you find that minimum acceptable is you take your target rate of return, how much do I want to make as a rate of return, and multiply it by the average total assets. So those things would be given to you in a problem if you needed to work it out, okay? It would say like, they have average total assets of $1 million and they have a target rate of return of 12% on their assets. So you take 12% times $1 million, which is 120,000. That's your minimum acceptable operating income. You take your operating income, subtract that, and whatever is left over, that's called your residual income, or your income over and above what you consider your minimum acceptable amount of income. Easier than it sounded right there. It's not too bad. So here's just a summary again that the book will have for you if when you're doing the work you get stuck, okay, of ROI and residual income. Again, the problem with using these measures is that average total assets is just a measurement and it can change pretty rapidly. This says measured at a point in time, which is a lie. That's why we're doing an average, so it shows an average across a point of time. But and sometimes we have what's called non-productive assets. So you could have these assets sitting there doing nothing, and a lot of businesses decide, oh, well, we just won't count those because they're not doing anything. And I would submit that that's exactly what we're trying to figure out is, do I have assets that are sitting there not producing, and if so, why? Are they not producing because they weren't meant to produce? Or are they not producing because we're going to hold them for sale later? Or are they not producing because we want them to produce and they're just not, and then we should do something about it? You see, all of this managerial accounting comes down to a final question, which is like, what do we do about it? The number of people who run their businesses and have things that need to be done but just aren't doing them is pretty much 100% all people running businesses. I have so many things that need to be done at my business, but I'm busy and I've got a job on the side of my business. But it's pretty valuable to be able to measure these, say which assets aren't producing, and then make a plan for those assets, whether it's to sell them off, whether it's to get them to where they are producing, whatever it is, okay? The other downside is a short-term focus. Sometimes when we're thinking of ROI, it's looking at the last year, where we might have assets that aren't producing right now, but over time will. And if we just decide to sell them because they're not producing the ROI we want them to produce today, we could be making a mistake, right? That's why you still have to, if you're decentralizing properly, your senior management's making a strategic plan that says we have a plan for this in the future. And we're willing to sort of kind of take a loss on this thing today, knowing what it's going to pan out in the future. So those are the downsides, and you have to counter those by being strategic in your thinking. And that's it. Like I said, I can't promise you that you'll agree with me. I know Riley won't because he's asleep. But I believe this to be probably the easiest chapter we've had, not only in this class, but also in the previous class as well. So the homework should not be too bad for you. Get a jump on it, and you'll probably easily be able to finish it in class. Any questions? We're done a little early because, well, it wasn't a hard chapter. All right, have a great day.